On May 12th, the market had one simple problem. The inflation number was too hot for the easy rate cut story. April CPI did not just nudge expectations. It made investors ask whether the Fed has enough room to help if risk assets wobble again. The headline CPI number was 3.8% year-over-year. Prices rose 0.6% for March, and core inflation moved up to 2.8% year-over-year. Those numbers are still too high for a market that had been leaning on policy relief. A hot inflation report does not mean the Fed has to hike tomorrow, but it does make cuts harder to justify. If prices are accelerating while growth still looks firm, the Fed has less reason to rush in just because expensive stocks start to shake. That is the real policy story. The Fed does not need a personnel drama to become less helpful. If inflation is hotter and growth is still firm, the bar for rate cuts rises. For stocks, that means the discount rate cushion gets thinner right when valuations need it. The tape showed the pressure. The S&P 500 slipped from its record, the Nasdaq fell harder, and the Dow managed a small gain. That is not panic. It is a more selective market, where investors are less willing to pay up for every growth story at once.
Energy is where global tension turns into household inflation. The Labor Department data showed energy doing a lot of the work in April, and oil was still moving higher on the day. That keeps the inflation story alive, even if other parts of the economy look steady. The rate story also showed up in income stocks. In the BDC space, Blue Owl Capital reset its base dividend lower, and 6th Street Specialty Lending lowered its base dividend after a weaker quarter. For yield investors, this is what a tougher rate backdrop looks like in practice. The awkward part is that the economy did not look weak enough to force easy policy. One source framed nominal GDP as running above a 10% annualized pace over 3 months. Treat that as an estimate, not gospel, but the message is clear. Hot growth plus hot inflation is not friendly to rate cut hopes. That is the box. If growth holds up, the Fed does not have to rush. If inflation keeps pushing higher, the Fed cannot easily cut. And if stocks are already priced for relief, even a small shift in rate expectations can hit the most expensive parts of the market. There was still a counterpoint in tech. Some investors are looking again at beaten-down software and payment names like PayPal, Adobe, and Salesforce. That does not solve the macro problem. It just says stock picking can matter more when the broad growth trade gets less forgiving. I would not turn this into a crash call. A 3.8% CPI print is a setback for the easy money story, not proof that every risk asset has to fall tomorrow. The better read is simpler. The market's margin for error got smaller. The watch list is direct now. Watch the next inflation prints, oil and gasoline, treasury yields, BDC dividend coverage, and whether growth cools enough to give the Fed room. If energy stays firm and inflation keeps bleeding through, the market has to keep repricing the odds of relief. So the takeaway is simple. May 12th put the rate cut trade back on trial. Stocks can still work, but the market is getting more selective. Strong balance sheets, real cash flow, and disciplined payouts matter more when inflation refuses to make the Fed's job easy.